So welcome to our webinar titled Unlocking the Mystery of Australian Expat Tax Planning in the USA. In this webinar, you will discover the key fundamentals of the Australian and US tax systems and your obligation in each of these jurisdictions as an Aussie expat working in the US. You will also learn how to maximise your unique financial opportunities through tax planning and how to avoid costly mistakes. So now I'm excited to introduce our presenters. Steve Douglas joins us from SMATS Group. He is the founder and executive chairman. Steve is a chartered tax advisor, a registered tax agent, and a fellow of the Taxation Institute of Australia. SMATS Group are international leaders in providing Australian tax, finance, and property services to Aussie expats since 1995. I'm also honoured to welcome Jason Stoch, the Managing Director of Uptrend Advisory based in the USA. Hi, Jace. Jason is a US certified public accountant, as well as a chartered accountant in Australia and New Zealand. Jason has more than 10 years experience helping expats with his unique expertise and knowledge of the Australian and US tax systems. So before we kick off, if you do have any questions, feel free to either type them into the Q&A area or the chat area, and we'll endeavour to answer them at the end of the webinar. So over to you, Steve.
Thank you, Jules. Well, we're conscious of the fact that we're on different time zones, both internationally and within the US. So some of you will be getting, a bit weary, and others will be ready to rock and roll. So we'll try our best to make sure we keep it fresh and interesting, and don't send any of you to sleep on the exciting topic of taxation, which we know everybody just loves and adores. Great to be doing this with Jason. We've been strategic partners for a while now. Because there's just too much for all of us to keep in one head for all of the issues on both sides of the border. So teaming up is a significant advantage. We'll have a bit of fun today. We'll look at some of the key issues and hopefully give you some good guidance and direction. But as with all, we have to start with a disclaimer. I can't stress how much the complexity of everything is when it comes to cross-border taxation. And when you throw in two big taxing countries like Australia and the US, the complexity gets even more and more dense than any other place on earth, I think. So hence, bear in mind, this is giving you a general review, but please do not act on any of this information specifically. We're free and available to help you out. So come along. We obviously handle compliance issues. We do tax returns. We do planning. We can give you an advisory. So if you need any specific information, please come and talk to us. We're more than happy to help you and get you in the right direction. I'm probably going to kick off with the key issue of residency. And, today we're obviously putting this together primarily for a group of Aussies that have now been switching jobs and heading to the US to work for an airline over there. There's a big cluster, so a big shout out to all of those. But it's relevant across all industries and everything's the same for all. What you have to start off as an Australian is the first thing is consider whether you are going to become a resident or not. And that is largely impactful because whether you come under what's called the double tax agreements between the US and Australia or any other country for that matter, or you become a non-resident. Now, double tax agreement is where you're likely to be taxed in both places, where you may indeed be resident for tax purposes in both places. And then there's various rules to ensure that you're not hit too hard and that credits flow for tax paid in one country or the other, or who has the dominant taxing right. So, if you are not sure about your residency and you are bouncing between two and it's impossible to differentiate which is the dominant, then the DTA is there to protect you. Whereas if you become a non-resident, and for Australian tax purposes, that's largely if you do physically move overseas, and the Commissioner says for an indefinite period of time, which is generally guidance as 2 years, then that makes life a little bit easier because you become in Australia taxable on virtually nothing except your rental property. So, all of the taxing obligations on salary and those things move across to your resident country, which in this case would be the US. So it makes things a little bit easier to clarify, but we have to establish which one you are. In doing so, I always try to remind people that it's not your choice. Many people say, oh, which one should I be? Which one's best for me? And that's not how it works. Residency is not a tick box. It's a factual legal position. And as a result, you need to look at that and say, well, which one is relevant to me? Now, in Australia, currently, the rule says that you are a tax resident if you are in Australia more than 183 days. But it goes on to say comma, unless the commissioner is satisfied you're living overseas. Now, that's where allegedly some complications come along, because if you happen to be in Australia more than 183 days, you can still be a non-resident. And this was particularly relevant during COVID, for example, where people were forced to be stuck in Australia, couldn't travel, whatever the case is. So it is possible to be a resident or a non-resident if you are more than 183 days in Australia, but only if you're very clear that you're a visitor, not living there. The key tests around residency in Australia still remain on two major things for me, and they are: do you have a home, and do you have permission? Okay. Now, and particularly when you're establishing non-residency, if you're trying to say that you are no longer resident in Australia, the commissioner will not look at that unless you can demonstrate that, number one, you have a genuine long-term home. That doesn't mean you own it. You could rent it, or it could even be serviced. But more particularly, that you have permission to be in that country, i.e. you have an appropriate visa. You're not just there on a travel visa, a holiday visa, etc. You're there on a long-term visa, and they're looking for, say, a prolonged period, permanent intention, that's going to be the case. Now, these days, in many cases, a lot of people are not necessarily taking their family with them when they go on overseas assignment. And that in itself in Australia isn't problematic unless it is impacting the genuineness of the circumstance. Now, in the US, for example, as Jason will say, I think they do family tax. So you include husband and wife, where in Australia, we only look at individuals. So what your wife or your husband might be is not necessarily going to impact your tax status, but certainly it could influence if you're trying to say that you're not living in your home. They'll say, really, that's unusual. Prove to us that that is the case. You've also got a situation where, are you a FIFO worker, fly in, fly out, or are you actually a visitor to Australia? And this, again, is the commissioner is trying to establish where is your base. So do you live in Australia and then pop overseas for work? Or do you live and work overseas and pop back to Australia to visit the family? So it's important that you differentiate the two. And we often say to people that, it's important to get, documented evidence of how you perceive the situation, i.e. don't just have a telephone call with your spouse saying, hey, I'm going to do this, or I'm going to come and visit you, or whatever. Put that in a text, WhatsApp, email, etc., because you're highly likely to have that evidence verbally. But always bear in mind, the commissioner may not even ask you about your residency for 3, 4, 5, 6 years down the line. And in that case, if you don't have anything that is physical, such as an email or a WhatsApp or whatever, he's likely to not believe you if you just tell him, oh, I told my wife that, because he's going to say, no, you'd say whatever it is to pay less tax. We don't believe you. Where's the proof? And an email 4 or 5 years earlier saying, hey, I'm going to go overseas and work in America because that's important for my career. I understand that for the sake of the kids, you want to stay there. Hopefully, we'll cross paths soon and we'll do this for a while because that's what's best for the family, and it will be reluctantly apart. That sort of stuff is critical. So keep that evidence. And he's very much going to look at the genuineness of your circumstance, and that's where that evidence again piles up and supports any contentions you have. So, look at your situation. So, well, do you genuinely feel you're living overseas, or do you genuinely feel you're in Australia? And I can tell you, having done this for almost 30 years, I've never met anyone that doesn't know where they live, but I've met loads of people that want to tell me that it's not that, because it might suit them. So I strongly believe everybody knows if they're a tax resident or not. There's only a few people that would fall into the grey. But what happens is sometimes we try and suppose which is best for me, and then it gets confusing. It's literally, as I mentioned at the start, it's about fact, it's about circumstance, it's about genuineness. And then, once you work out that, the residency is not too hard to find. Having said all of that, we may be throwing all of that out, sometime soon, because they are proposing to change the residency laws. They're proposing to make it easier, allegedly, but anytime the tax office talks about easier, it normally becomes more complicated. And they're making it easier insofar as they're saying, let's just make it you're a resident if you're in Australia for 183 days full stop, which we support and recommend. But for some reason, they've gone a step further to say, oh, let's introduce a secondary test that says if you're in Australia for, at this stage, proportionally 45 days, let's apply some tests that, if you pass those tests, that you'd be a resident. If you look at those tests, and I won't go through them because we still haven't seen the legislative draft yet, but the proposed test would mean that I don't think anyone would not become a resident if they're in Australia more than 45 days. So that's something that we've been petitioning on and lobbying. We had a petition went to Parliament before the change of government with over 5,800 signatories, which was a record for a tax petition. We are getting noticed. We've seen a delay there, and I think that petition caused it. It was meant to have come into effect 1st of July this year. We've pushed that now to at least 1st of July next year because it will not start if these changes come into effect until the 1st of July after the passing through Parliament. So at earliest, we're going to see these changes 1st of July next year. I'm not sure that they can get the legislation through in time, and especially if they stick to their word and give us consultation. So, don't worry about this yet until we see the legislation. We'll obviously keep you up to date with it, and we'll be lobbying hard. We're trying to get rid of the 45-day test in full, if not extend it to 90 or 120 days to be more sensible and allow for people that do commute. So residency is the starting point for everything for an expat, and hopefully that gives you a bit of a guidance on that. I'll pass to Jason now, who'll talk about some of the US issues.
Thank you, Steve. Thank you. That's a great recap and bringing everyone back up to speed on where things are at with the new proposed tax residency rules. On the US side, I'm conscious that there are some attendees who have been living in the US for years and know it or are pretty much more comfortable with it. But to Steve's earlier call out, there's a big group of Aussies who are relocating to the US who this is all going to be brand new for. So I will go over the 101 kind of basic stuff just to give everyone a bit of a framework and then go into more of the details. So, at a very high level, the US tax system is quite different to Australia. So Australia has a June 30 year-end tax year, whereas the US is a calendar year, so January 1 through December 31. In tax season, it's typically January through April of the following year, where, for example, your 2022 tax year or tax return would be due April 16 of next year. In Australia, there's one level of taxation, but in the US, there are typically two levels of taxation, and that's federal with the IRS, who has the tax treaty agreement with Australia. And then at the state level, if the state you're living in or working in levies state income tax. So that would mean that you have to file either one or two returns annually with the respective government entities. Now, similar to Australia, your tax residency determines everything. And in the US, it's quite different and quite more detailed and complex when you are a tax resident. So it's determined by your visa or your citizenship. So if you're a US citizen or a green card holder, you're always going to be a US tax resident. It's very black and white. But other visas, such as the E3, would have your tax residency determined by whether you pass something they call the substantial presence test. The substantial presence test is if you have spent more than 183 days in the country in a calendar year. Similar to Australia, it's very black and white. They do have the ability to look at the number of days you have spent in the US in the prior 2 years and apportion some of those days to that 183-day test. But overall, that's the basic test. If you pass this test, you are a tax resident. But if you don't pass it, you're not a tax resident. And that kind of drives your various declarations and obligations. So, when you're a resident for tax purposes in the US, you do have to declare your worldwide income. So everything you've got in Australia, such as investment properties, shares, dividends, capital gains, interest, the entire farm. Where the IRS takes it a little bit further than the ATO is that they also have a whole bunch of foreign asset disclosures that you have to complete annually if you meet the thresholds for them. They also have the ability to want you to declare certain foreign structures that you might have, like proprietary limiteds or trusts, if these things apply to you and are set up in a certain manner. So when it comes to the US tax system, besides declaring all the income, a big part of being an expat in the US as a tax resident is actually about compliance and making sure you're completing all of these foreign forms, because if you're not declaring it and you're not declaring it correctly, if the IRS manages to find out somehow, they do hit quite hard with their penalties. And so for any of you that are on the call that have been in the US for a while, and this is news to you, there are ways you can get back into compliance. So just know that that is an option for you. Going back to a non-resident though, it's a much cleaner, much easier situation. Similar to Australia, if you're a non-resident for tax purposes, the only thing that goes on your US return is what's US sourced income. So US employment income, stocks, dividends, everything, but there won't be any mention of any of your foreign income or investment activities. Now, at the state level, it's a little bit different. So if you're in a state that has state income tax, or if you're in a state that doesn't have state income tax, that drives what your obligations are. So let's say that you're living in California, you would need to file annually for your various income streams. But if you lived in Florida, there's no state income tax there, and so there's nothing to file. Where it can get a little bit complicated though is, let's say you live in Florida, but you commute to California and work there and you're earning income there, then you would actually still have to file a California return, but you'd be filing as a non-resident, where the only thing in California that is on your return is your California sourced income. Another critical thing to be aware of is that I mentioned that there's the tax treaty between the IRS and the ATO, and that's because it's a federal arrangement. Each state operates almost like their own country as to whether they will abide by the tax treaty or not. And so this means, ultimately, are they going to allow you a credit for the tax that you've paid to the ATO on the same income you're declaring to that state? So states like Illinois do allow foreign tax credits, but other states like New York or California don't. So that's really important to be aware of, especially, if you're considering, selling your home in Australia, knowing that California would tax it outright if you're a resident there. So making sure you're planning that's pretty important. The next one is dual tax residence. So there are situations where one can be a dual tax resident, such as, a US citizen living in Australia. But for Australian tax purposes, they would remain a tax resident. And for US tax purposes, they would be a US tax resident. This means you would need to essentially leverage the tax treaty agreement to ensure that foreign tax credits are claimed appropriately to offset any kind of double taxation that occurs there. 401k and Roth, again, some of you might already be aware of what these things are from living in the US, but for those who aren't, the US has a different retirement system compared to Australia's superannuation scheme. There are a lot of different names for these types of retirement funds, such as 401k, Roth, IRA, SEP, but the main two are 401k and Roths. Unlike Australia, where the employer has a mandatory obligation to contribute to your superannuation, in the US, it is discretionary and is considered a perk. So when people are typically accepting and negotiating positions, they tend to consider whether there's something called a 401k match, which is based on how much you put into your 401k, your employer might match a percentage of it. So that is typically something that is weighed into, the whole package of what the job offer is. A 401k is a tax-deferred retirement vehicle where in the year you're contributing to your 401k, it reduces your taxable income that year based on how much you're putting into that fund for the future. And then when you withdraw from that fund at retirement age, which is 59 and a half years old in the US, you would then be taxed on how much you've withdrawn at the marginal tax rates for that year. A Roth is a little bit different in that it's not tax deferred. It doesn't reduce your current year taxable income when you're moving money into that account. The benefit though, compared to a 401k, is that any growth in that fund is tax-free. And so when you eventually draw down from it in the future, there's actually no tax on the withdrawal whatsoever. The big thing and the big caveat to that though is that these two funds should be considered and thought through when you are thinking of moving back to Australia, because the ATO will tax them.
Okay. Right.
Okay, so this one is specifically for all the pilots on the call. So again, apologies to everyone that already knows all of this information. It's quite unique to pilots though, actually, so it might be interesting. So from a federal and state tax level, as a pilot, you are liable for federal taxes based on your US income that you're earning. If your tax home is Australia though, and you spend more than 330 days outside of the US, you might be able to qualify for an exclusion called the foreign earned income exclusion, where you can exclude some of that income that you're earning that's foreign from being taxed by the IRS. I'll define foreign more in a little bit, but just wanted to flag that as something. If your home is in the US though, then you will pay full tax on your US income. There's no ability to exclude what's considered foreign. At the state level, this is where it can get complicated again, because your earnings are taxed by your state of residency and any other state where you're earning more than 50% of your pay. So going back to the example, let's say you live in Florida, but earn more than 50% of your pay from California. That would actually make you have to file a California return to pay tax on that California sourced income. So as a pilot that's moving around a lot, you may need to actually start tracking your flight time in each state to determine if you actually are going over that 50% threshold. Now, in terms of claiming expenses and allowances and everything like that for the various things that happen as a pilot, you used to be able to claim and deduct these things until the Tax Cuts and Jobs Act of 2018 repealed all of these deductions, and it's going to be repealed until 2025. So at this stage, unfortunately, the best course would be to seek direct reimbursement from your employer for these costs, assuming that they have such a reimbursement program. Steve, did you want to quickly touch base on Australia's view on those allowances?
Yeah, if you, I suppose you have an advantage, you know, in Australia if you happen to be able to keep yourself as resident and therefore had to declare that income in Australia, where allowances, the ATO has made special provision that is, if they're within certain levels or limited to the allowance that your employer gives you, then you don't need to have receipts to justify it. So there's a little bit of wiggle room and flexibility if you happen to stay as an Australian tax resident and therefore have the necessity to declare both places. But you have the quandary that what's working in one country isn't going to work in the other. So you're still going to have that double juggle to deal with, which is just a pain in the neck.
Yeah, it's one of those cases where Australia's got something better than the US, but there are times where the US has things that are better than Australia. It's not a like-for-like tax system.
Jason, are you sure? We've been brought up to believe Australia was number one.
Well, America's the best country in the world, apparently. So,
Good.
Yeah,
no worries. So we'll probably get a little bit of tax planning issues now, just to sort of give you some thoughts. And again, it's a very big playing field, the tax planning, and it depends on a lot of things. Obviously, your capacity to save, your tax, your earnings, your residency, your objectives. So it's a very personal thing. But between Jason and herself and ATS and Uptrend, we'll obviously give you all the guidance and make sure that you're working out what's best for you. But there's some general things to consider, and obviously if you're leaving Australia in particular, one of the advantages you do have in Australia with your primary residence is that you can rent it out for up to 6 years and it still remain capital gains tax free. So if you have a residence, that's great. But one of the things that you might want to consider if you're going to do expatriate life is you might want to, prior to departure, accelerate the acquisition of a home or move into a rental property or something that you may have in order to make it your residence. And for that, it needs to have obviously the electricity bill in your name, that sort of stuff. So ideally moving your furniture in, etc. But that can give you an opportunity to potentially save a lot of capital gains tax on sale if for up to 6 years of rental. Now you've got to be mindful on that, which we'll talk about later, because they don't make that happen if you are going to sell while overseas. So I'll bring that to more attention later. The other thing you want to do as an expat is definitely find out if you are in a borrowable position. Now in some countries, particularly if you're going into the Middle East or Asia where the tax rates are lower than Australia, you can increase your borrowing capacity. In the US, it's a similar tax regime. But you've got US dollars, so you may be in a situation where you've got a higher capacity to fund, and it's always a good idea to check what lending you've currently got and check what lending you could get to see if you want to use that borrowing power and enhance that borrowing power while you're away for further acquisition in property, etc. And the key thing is if you have a home, as I mentioned, they changed the rules in 2000 to basically say that, if you sell your former family home whilst living abroad, they will treat it as though you never lived in it and you'll pay full tax. Now, the Liberal Party brought this in. It's an absolute shambles. It's one of the most unjust, rules out. We did lobby at the time and we managed to get them to at least bring in some bad experience provisions that if you're unfortunately subject to an illness or a divorce, that they will grant you an exemption from losing the residence tax-free status. But basically, if you sell it, whilst you're overseas, even if you had lived in it for 20 years prior and you sell it 2 weeks after going overseas, you would have to pay tax on the profits for the whole 20 years. So as such, one of the key expat planning issues now is thinking, do you want to keep that home during your expat assignment? If you were contemplating selling it for whatever reason, then you should contemplate selling it prior to your departure. Now, importantly for capital gains tax in Australia, the sale date is the contract date, not the date of settlement. So you'd need to sign an unconditional contract prior to your departure in order to get tax-free still. In the same breath, you'd need to sign that contract when you come back and are living in Australia permanently. Now, it's important to note that you can't just come home for the weekend, say that you're a resident, sell your home and then rack off again. But people do try things like that. So it's important to you to say, hey, do I need to sell this house if I'm going overseas? That might be because you want to upgrade it. I want to realize cash, you might need the money. Or are you happy to keep it throughout the time abroad? If you are, then certainly make sure you do not sell while living overseas, because you'll be up for a lot more tax. One of the other things that happens on non-property assets, such like shares, etc., is there's a deemed disposal of those assets. So you have to pay capital gains tax at the time of departure to the market value on departure. Now, you do not have to actually sell those assets. It's just on paper that they calculate the capital gains tax. And what that means is that if that happens, they will become tax-free from that point on. Now, you do have the option to nominate to defer that tax until such time as the actual sale occurs in the future. But rarely is that worth doing. Usually the only time you would do that is if the asset had fallen since you had left the country, or if or basically if you I can't even think too many other circumstances you'd want to do it. But you just basically want to make sure that you're assessing whether to do the deemed disposal or not. Check out what you want to do there, and it's a nomination in the tax return in the year that you leave the country. You want to look definitely at buying a future residence whilst you're overseas, and hopefully you've got additional funding capacity. You may have equity in your previous home. You may have additional savings. Whatever the case is, we've been nagging people to buy their future home in Australia for 20 over years and never had one complaint in doing that. It's not that Australia is a dynamic property market, but it is a strong, solid, stable growth market. And the cheaper the earlier you buy your future residence, the cheaper it is. And hopefully the growth that you have whilst you're overseas is less money you have to pay if you had not bought the property. So for argument's sake, if you want a home now and it's worth $1 million, you're best to buy it now, borrow high, rent it. There's lots of tax advantages in renting out the property. It neutrally covers itself, negative geared. The rent, is basically covering most of the expenses. And what that means is that $1 million house, maybe when you come back in 5, 10, 15 years is worth 1.2, 1.4, 1.5, but you didn't have to pay that extra because you bought it at 1 million. And that means you've got less to pay off, less to contribute, and you're in your future home and you've had some tax advantages accrue along the way. It also means that you can quickly work out your debt reduction targets. And by that, what we mean there is that we're very, very determined to try and help all of our clients to be low debt, no debt on their family home when they return to Australia. So one of the advantages of buying that home, either prior to or during your expat period, is that it then becomes a known target. So if you did buy that $1 million property and you took an $800,000 mortgage, then you know that your savings target is now $800,000. The downside of not buying is you don't know what that savings target, that purchase budget is going to be because you have not yet acquired it. And it is unlikely to be getting less and less. It's more likely to get a little bit more and more. So the sooner you act, the better off you are. If you have got debt and you have got spare money, we probably would discourage you from reducing what we call tax deductible debt. And that basically means any debt associated with income producing asset. So even your family home, while you were living in it in Australia, you do not get a tax deduction for the interest cost. But if you move overseas and then rent that home out, that interest now becomes tax deductible and goes from being what we call bad debt, private, to good debt, investment. And that means that the tax office and the tenant are paying for it more than you are. If you have a tendency that you want to reduce debt, then we'd inclined to push you towards paying off any private debt you might have, such as credit cards, even your university debt, those sorts of things first that are not giving you tax advantage. And if you are even determined to reduce your interest cost on your loan, rather than pay it off, we would encourage you to use things like an offset account, where instead of reducing the debt that is tax deductible against the rent, you just put money in a separate account and it will reduce the interest cost because they net the two off. What that means is that the money is available to use for alternate investment without affecting the debt being applied against the rent. Now, that might mean that the money goes into your next acquisition, your future home. It may be for investment purposes or whatever, but you get the choice to do what's best for you. So avoid reducing any loan any more than you have to if it's tax deductible. And you need to be very key of your timelines. And this is critical. Again, with the fullness of time, having done this now for so long, you'd be amazed how quickly time does fly. And so you want to be aware that why are you going overseas? What is your motivation? Is it to save? Is it for career? Is it for life enjoyment? What's the duration? For many people, children are a key trigger point. They say, look, we'll go overseas until the children are at high school or primary school or whatever. Parents are a consideration. A lot of expats return because their parents are now getting to an age they need to be helped and supported. So always be aware of your objectives and your timelines, because that's going to affect your planning, whether you are aggressive or whether you're quite passive, whether you hurry up to acquire or whether you say, look, we'll do it in a couple of years after we've been burnt on the beaches of the Bahamas many times. So be very clear of what you're doing it for. And then when you come back, we have the reverse of the deemed disposal insofar as we have a deemed acquisition. Now, the only thing that stays taxable for you as an expatriate is Australian property, i.e. your home, your rental properties, etc. All other assets that you may acquire along the way, including shares, including maybe property in the US or other places, they're not taxable while you're an expat, but they become taxable on a worldwide basis when you're an Australian resident for tax purposes. But when you come back, they're deemed acquired at market value on the day of return. So if you had shares, that's very easy because you obviously look at what the share price is on the market. If you have a property, you need to get a licensed valuer. I jokingly say all the time that the law says they have to be qualified. It doesn't say they have to be sober. Excuse me. And what that means is you obviously want the highest value on return, because you're not paying Australian tax until it's profit above that valuation. So the highest point that is, and just assess whether you need to retain those assets or sell. Now, there's no real tax implications if you sell those assets. A lot of people think, oh my goodness, I'm going back to Australia, I have to sell everything. Well, the answer is you don't. So don't sell everything unless you need the money, for example, to reduce your home's mortgage, or you need the money to buy a home, or you need the money for a purpose, because there's no real tax implications, selling it prior, on, or just after arrival, because it's that market value that's taxable anyways. So make sure you do it in calm decision-making authority. And one of the things I often say to my clients is not should you sell, but would you acquire? So if you look at it as should you sell, that can be confusing and emotional. But I just say, okay, what have I got that's still there? Would I buy it at today's price right now if I had the choice, if I didn't already own it? And that usually is the best, most sobering way to make good quality decisions, because you get to keep your quality assets, dispose of the ones that aren't that good, put it into a better form, and then have a happy life. So there's some of the key issues you want to go. You have the ability as an expat with property to build up losses, which we call tax credits. So that becomes very good. Now, it's not as good and dominant as it used to be in the good old days, but that's only because interest rates are a lot cheaper than they used to be. Even with the recent rate rises, it's hard to get a property to negative gear now, but a couple more rate rises, that might become more fashionable once again. But, certainly, go abroad, have a good reason, think about your future, and start bringing your future into the present as quickly as possible. Over to you, Jason.
Okay, so in theme with what Steve's been saying, you've been living in the US now for a number of years, and you're thinking of moving back to Australia. It's probably good to do a list or an asset list of what you're holding, US property, US stocks, retirement accounts, and thinking through how you are going to repatriate them to Australia if you had to, or if you wanted to. So all of these things, while from an Australian standpoint, you get a free step up in cost basis. Unfortunately, in the US, when you're liquidating things, you will trigger tax with them. So, from a stock perspective, depending on your tax residency, you might be able to keep your US stocks in the US on that brokerage account. You're not forced to liquidate them and sell them. You might also be able to directly transfer that stock from a US platform to an Australian one if that Australian platform houses the same stocks. And you transferring stock is not a capital gains event. It just means that you're able to escape US tax on it and essentially get a free step up in cost basis to Australia, which is a win. If you were having to sell stock, then that would trigger capital gains tax, either short-term or long-term, and it's just something for you to think through. But those things are, more specific to an individual that could be considered, but is something to speak to, myself directly so that we can do it properly. When it comes to property, assuming it's US property, there are various tax rules and deductions that you can claim on the sale. Any improvements you can claim on the sale, any selling costs similar to Australia, marketing, legal, tax, all of those things you can claim. Unlike Australia, where if it's your primary residence and you're exempt from 100% of the capital gains, in the US, it's different. In the US, the rule is if you have lived in the property for 2 years out of the most recent 5-year window, you're exempt on $250,000 of capital gains if you're filing as a single person, or $500,000 if you're filing married with your spouse. So there are benefits there. It's one of the situations where Australia's got a better situation than the US when it comes to selling your primary home. But it's something, to speak to a professional about to see what exactly that means for your specific situation. When it comes to the retirement accounts, the 401k and Roth, as I covered before, given they would be taxed by the ATO, you would need to think through and plan how you want to access these funds when leaving the US. It's definitely something to talk through with your accountant to understand the implications. Something to flag is if you were withdrawing from your funds before 59 and a half years of age, the IRS does levy a 10% early withdrawal penalty on however much you've withdrawn. So that should also be factored in here.
Okay. Okay, let's move. Right. Having a look at some of your choices whilst you're spending time overseas, hopefully you are going overseas to better your, not just career, but also your financial situation, your earning capacity, etc. I've always said that, the experience of being an expat is just not enough. We've got to get ahead financially, and that's important. So obviously property, I mentioned a bit earlier how important that is, but it really is probably the number one thing that you can do as an expatriate. Thankfully, as Australians, we're quite self-obsessed with property, so I never have to convince anyone too hard. And as I mentioned earlier, one of the advantages, you can build up tax losses. If you do have your expenses more than your rent each year, so the rent minus the ownership costs, such as rates, taxes, maintenance, minus the interest on the loan used for the property while it was your residence or that kept thereafter. And then you also get depreciation allowances on the property for the building cost if it was built after 1995, and also things like your stove and all that sort of stuff if you put them in there. So usually a combination of all those will create a small deficit or neutral position. With interest rates being low, that's been harder to do. But if you're back with a 70-80% loan, and 80% is generally your max, you should be at least break even, and hopefully the depreciation is pushing you into a small loss situation. That loss carries forward indefinitely and keeps accumulating whilst you're overseas. So if it, for argument's sake, is costing you $10,000 a year to own a property, if you're away 5 years, you've got a $50,000 tax loss or tax credit, as we call it, built up. And when you go back to live in Australia, that tax credit can offset your first year's salary and mean that you don't pay tax for that first 50 grand of wages. So it becomes very, very attractive and is an encouragement to buy earlier rather than later. Now, having that said, I wouldn't do it just for the tax benefits, but certainly for the benefit of getting a good quality property with tax advantages, it makes a lot of sense. You want to obviously, get into any debt that you can to buy those properties. And being an expatriate, as I say, you hopefully, should have a little bit bigger budget. It is harder these days to get loans. A lot of the banks won't lend to people that are living overseas at the current time, but there still is some good lenders that are lending out. And particularly if you've had your home in Australia for a reasonable period of time before you leave, and you might have paid the loan down quite aggressively, and there's a lot of equity from the combination of the growth and the value from when you bought it to the reduction of the debt, that equity is available as a deposit, in essence, on your next purchase. So in many cases, you might find that you can buy a property without any cash deposit, from using the equity in your current properties. If you can do that, you might be pleasantly surprised as to how big your budget may be, and that how you can bring your wildest dreams to fruition. So see if that's available to you. Check out with your lender. If they're not agreeable, talk to us. We're specialists in finance there. We can help you get that loan, no worries at all. And what you want to do is have a look and see anything that you're buying on the property spectrum, whether it's going to have a future use for you. So whether it's be a future retirement home, a future apartment for your kids to study in, somewhere that you would live when you go back. I always encourage people to do that because you tend to pick better properties, which tend to grow at better rates. So if it's something that you like, it's more likely to outperform something that's just average. So, I don't like the concept of investment property. To me, there's only good property that is a good investment, but you've got to be careful not to buy bad property just for the sake of ownership, especially these days, as even though finance is available, it's harder to get larger sums. And the more properties you own, the more finance you have, the harder it is to get the next loan and the next loan. So it's really important these days to focus on building a good quality portfolio rather than a large volume portfolio. if you're doing that, you have the ability of having those properties build up. Now, you do lose your 50% tax-free as a non-resident on general assets, and potentially if you sell your former family home while living overseas, you lose that 100% tax-free. But what will happen is when you go back, if you sell that former residence while living back in Australia, not back in the same house, but just in Australia, then you would get that tax-free period and up to the 6 years extra, which becomes highly tax effective. So you want to make sure you're not selling till return. You also want to be looking at buying it now, because even when you go back, you will get the 50% tax-free on a pro rata basis for time living in Australia, divided by total period of ownership. So it's still a very, very tax effective vehicle, offsetting future salary, giving you some capital gains and giving you a nice base. In terms of other assets, you need to be mindful that it's good that you're an expat from an Australian perspective, because if you buy shares in Australia, for example, those shares do not have any income tax or capital gains tax for you to worry about in Australia. However, as Jason has mentioned, if you're living in the US, they do tax you. So it's tax-free in Australia, but not necessarily where you are. If you're lucky to be in countries like Hong Kong, Singapore, the Middle East, most of those countries don't have any capital gains tax or income tax on offshore or even onshore in many cases. So that's when you get the benefit of having it tax-free completely. But you just have to be mindful that you will get it tax-free in Australia, but you have to be mindful where you are. And if you're in the US, it's not going to be. Obviously, property is quite an illiquid asset. It's hard to sell, and we also don't like selling them. So having other investments is a good thing from a liquidity and convenience point of view. It means that if you need money, you can get it quickly and easily. And one of the things that we do always encourage people to consider is what we call rent replacement. If you're going to be overseas, particularly for a long time, 3, 4, 5 years, and particularly if you might get allowances or if you have some spare cash flow, buying a property in your country of residence, to own and pay off whilst you're overseas is a smart way to potentially get some gains and maybe your rent back. Obviously, if you just rent, the money's gone and gone forever. So, consider buying. Now, that obviously depends on budget, cash, availability, all sorts of things, risk in market, wherever you may be. So, weigh that up. But certainly buying whilst you're overseas can be advantageous. Now, again, some countries, make it a bit more difficult. They're either too expensive or they have, foreign buyer fees. The US doesn't. So it's certainly something worth considering if you can find something you like at a price you can afford, rather than paying rent, paying off the mortgage. And in the US, you have the advantage of getting your private mortgage as a tax deduction in the US. So that helps too. And then again, just always remember to get those valued on return, and those profits that you've made whilst overseas are all tax-free for you on your Australian tax in the future. So it's only future profits that you need to worry about. So, property, stands as a very good market and something that Australians have always loved and done well out of. It has good tax advantages. And then the other assets, you're basically using as an alternate wealth creation, and you look at get some tax advantages as an Australian along the way. But Jace, over to you.
Okay, just one more point on the property. So besides the capital gains exemptions you would get from selling your primary residence, in the US, there is a type of deduction called itemization, where you actually could potentially deduct some of your mortgage interest on your primary residence as a tax deduction annually. So that's a US tax benefit from being a homeowner. Now, in terms of US tax pitfalls, because the IRS operates very differently to the ATO, there are some things to be mindful of, and just wanted to cover that these things only come into play if you are a US tax resident, where you have to declare your worldwide income and foreign assets. But if you're not, this does not apply to you. You're free to invest and do whatever you please. So the first thing is a PFIC, or a passive foreign investment companies. The IRS likes to have mouthful names for things that could just be named simply. So these are essentially foreign, from the perspective of the US, foreign domiciled mutual funds, index funds, ETFs. If you think of something like a Vanguard Australia, and what these funds are is it's a way for the IRS to tax them at a higher than ordinary rate, as well as the unrealized growth on them, just because they're foreign domiciled. If they were based in the US, it's just normal tax. So it can become quite costly and can make that type of funds a terrible investment, which is then compounded by the cost of having someone like myself to prepare these passive foreign investment company forms. Where it can get particularly nasty is if you have one PFIC a year, that's not bad, but what does that PFIC invest in? Does it invest in sub PFICs? So where it's one, it could end up being, 10 that you have to file for annually. So it can become quite costly and punitive in that sense. The next one is trusts. I know that in Australia, trusts are a big thing for many different reasons, but the IRS would view them as a foreign trust. So if you have a trust where you are a beneficiary or a trustee, you might have a foreign trust reporting obligation to the IRS annually, where they may be able to tax you on your distribution that you're receiving if you're a beneficiary, and where they can also potentially tax you on the actual growth within the trust, depending on if you're a trustee or not. So it's a pretty big deal and something to definitely be mindful of if a trust applies to you in terms of how you structure it. In that same vein, legal structures have the same kind of issues where if you have a proprietary limited where you own over a certain percentage of the shares, you suddenly have to report a foreign corporation to the US where they'll look to kind of try tax the profit held within that entity. So just another structuring thing to be mindful of and talk to a professional if that applies to you. The last one, superannuation, is the big one for a lot of people. It's a very great topic because while Australia and the US have that tax treaty to prevent double taxation, the language of superannuation has not been explicitly named in this treaty. And that tends to lead accountants to either have the opinion that it's taxable or non-taxable, depending on the weather. So the IRS would consider superannuation to be what's called a foreign grantor trust, which is taxable if the individual, had discretionary control over their superannuation. So control can mean a lot of different things. It can mean having the ability to choose where to invest your superannuation, which all Australians do. It can also exist when you have made the choice to make contributions to your funds. As the IRS has not made any rulings on what constitutes control for superannuation, it's up to interpretation. So another potential argument for control is that if you have contributed more than your employer to your superannuation over the lifetime of your funds, then your super could be considered a foreign grantor trust because you have made more contributions and therefore the growth would be taxable. Where it's pretty black and white is if you have a self-managed super fund, the IRS would deem that as a foreign grantor trust. So in summary, superannuation is an asset that is stated in your foreign asset forms. However, the taxation of it is still evolving and depends on your accountant's interpretation.
No worries. So just quickly about superannuation, following on from Jason's comments, and particularly in the US, it's a big minefield. And so, you definitely want to look at not having self-managed super fund and all the rest. But a lot of expatriates say, should I contribute to my super whilst I'm overseas? And regardless of which country you're in, generally the answer to that is no. If you're in a high tax country like the US, you're usually better off to follow their tax advantage retirement plans rather than the Australian one. And the main reason for that is that in Australia, you're not going to get a great tax deduction, unless you have a high level of Australian income. So literally the only time that it's usually worth putting money into an Australian super fund as a tax deduction is if you have some surplus rental income. So if you had a property that had good rent and very little mortgage and costs, if that was making $10,000, $20,000 a year, then maybe you would contribute that $10,000, $20,000 a year to the super fund. The reason you would do that is as a non-resident, your starting tax rate in Australia is at 32.5% from the very first dollar of profit. You do not get a tax-free threshold as a non-resident. So you're often better off if you had that rental surplus, rather than pay tax at 32.5%, you could contribute that money to super, where that tax would be 15% inside the superannuation fund, rather than you paying 32.5% outside. Again, if you're in a country like the US, you need to just double check that before you do it though, because it may still end up being taxable in the US, which would defeat the purpose. In which case you'd have been better to pay the 32.5% income tax in Australia and get that as a foreign tax credit to offset the US tax and nullify that. So it's something that you need to consider, but it's a bit crazy. The one thing I always remind people is that superannuation is just savings. It's just government regulated savings. It says, hey, put it in here, we'll give you some tax incentive on the proviso that you don't take it out and blow it at the casino. So that's great, but if you are saving anyways, you may not find that the government advantages of saving into super are worth your while. For example, you may want that money to build up and be accessible to reduce your mortgage. And we have a situation where Australians have in the main become a bit obsessed with their superannuation because it has the promise of being tax-free after retirement age, anytime after 65. But if I'm a strong believer that I'd rather have low debt, low super than high debt, high super. And so we're more obsessed with how we're going to get rid of your mortgage first, and then in the latter years when the mortgage is low or gone, how do we then turbocharge your contributions and your superannuation to boost towards retirement at that time? We feel that you're dramatically financially better off if you do that. But again, everyone's different. We have to look at your cash flow, your tax implications, your tax rates, all that sort of stuff. But generally speaking, you're always better to be having access to the money to reduce your debt than you are having loads of money in super that you may not even have access to. Now, that's particularly true these days because we're seeing a lot of people either retiring early or taking sabbaticals, in their 40s and 50s. Now, again, if you think of it like this, that if you've gone crazy making contributions in a super, so a fair chunk of your wealth is in either Australian super or might even be in 401ks in the US, if you did want to stop work for 1-2 years just to recharge the batteries, you might go in their starvation mode because all your money's stuck in super. And if you're under that 60 years old, you either can't access it or you can't access it without significant cost or penalty. So you've got to be mindful of what is your intentions and balance it the two. So obviously, as we get closer and closer to 60 and more clear of what our retirement intentions are, then we're probably more likely to put money into super at that stage, hopefully because we've reduced our debt, than if we were younger, where we're in our 40s and 50s, and we've got 10, 20 years left to be able to bolster our super, but let's make sure that our current life is not impacted too greatly. So as a general rule of thumb, don't be too worried if you're not building up too much super at the moment. As long as you're saving, as long as you've got a plan, as long as you've got clear intention as to where you're going.
And just off the bat of that, unfortunately, the IRS view is that superannuation contributions are viewed as taxable income. So while making contributions in Australia may help, reduce your tax, it simply shifts the burden to the US side. So just something to be aware of there.
As I mentioned, that's where you're likely better pay the Aussie tax and then get the credit in the US. Right, just some quick traps to avoid. Well, again, just to reinforce this because it's so critical. If you had a family home before you left and became an expat, do not sell it whilst you're living overseas, right? If you do so, whatever period that you would have got tax-free and up to another 6 years will become fully taxable unless you've either died or had some extreme life event. So please make sure that you remember that. It's one of the things that gets a lot of people caught out because it's only a recent change and not many people know about it. So spread the word. If you ever had a dinner party and someone's saying, oh, I'm thinking about selling my former home, I've made good money and I won't have to pay tax on it, just say, wow, stop. Before you put the for sale sign out, talk to these guys because you might be shocked to find out that that's not the case. You do lose your 50% CGT discount, but it'll be pro rata available. So if you keep the asset, when you go back, it'll be pro rated for that period. And this is one of the things that sometimes being a dual resident is not a bad problem because If you're a dual resident and you stay a tax resident, in Australia, then this 50% capital gains tax discount would still apply, as would the ability to sell your home. But remember, as I mentioned at the start, being a resident is not an option, it's factual. So don't think you could say, oh, good, I'm going to sell my house, so I'll pretend that I'm a resident and that'll be fine, because the tax office can easily come in and say, oh, hold on, you ticked that you're a resident, but we don't think you are, so therefore we're now going to charge you that capital gains tax backdated. So just be mindful, it's still factual. The deeming issues need to be considered, and they can be good in the US in particular, because if you do the deeming out of Australia, then you reset the capital gains tax clock, in Australia for when you return, and you also reset it for the US. The US, has a weird rule that's tax you right back to original earnings. So you just want to be mindful that, if you do the deeming, it could help on both sides of the fence. You have to look at what might happen if the assets have gone down in value, and then what you might want to wait till it's actually sold. And and the good thing is, when you do leave, you've got to make an election in that tax year. So what happens if you can imagine, if you left Australia in August or September in a year, you don't have to make the election till your 30th of June year end, which doesn't have to be lodged until 31st of May the following year. So if you left in August 2022, you don't need to lodge your return until June 23, which doesn't need to be lodged until May 24. So you got all the way back from May 24 to August 22 to say, what is my best choice? And that's a really big bonus, take full advantage. And obviously, the longer you intend to be abroad, the better off you are to be tax-free in Australia, and that deeming is probably more advantageous than not. So just think about that. The period does make it, the type of asset, the likelihood of growth, those factored. In terms of inheritance issues, the good news is there is no inheritance tax in Australia, so you don't have to worry about it. However, you need to be mindful that what happens is that you do inherit the capital gains tax liability of an asset when you inherit it. Now, if you inherit, for example, your parents' home, they would, you would be deemed to acquire that if they give it to you as in specie, as the property itself. If it was their residential home, it would come to you for Australian tax purposes at the market value on that date. Same as if it was bought prior to 1985, which is when we brought capital gains tax into effect, you would be deemed to acquire at the market value. If it was an investment asset, such as a rental property or shares, the way it works is you're deemed to be the original owner. So you would still have the capital gains tax to pay back to when your parents bought it at that original cost. So it comes with it. So you just got to be mindful that if it is not their home, you are getting a property, you might be getting the asset, but you also have to be mindful that sometime in the future, you're going to have a tax liability too. Now, that's particularly important if you're doing an adjustment with your siblings, where you need to say, hey, look, I'm not getting this $500,000 house because there's 50 grand of tax liability underlying. So it's really only worth 450. So that's something to consider and get advice on. And of course, any other assets you might receive, like shares, same deal. If your parents had bought it, 20 years ago for $5 and it's now 50, then you've got to have a look and say, oh, well, let's adjust for the tax implications that may occur. The actual transfer to you doesn't actually trigger the tax. It's your eventual sale that will. But, you need to be mindful of that. And that's why sometimes you might be better off selling the asset in the estate, let the estate pay the tax and just give you the cash, and then you decide what you want to do with the cash privately. But you need to have a look at all those things and see how they impact you. Jason?
Okay. Yeah. So in the US, there's no inheritance tax at the federal level when you inherit cash, investments, or property. But any subsequent earnings from those inherited assets would be considered taxable unless it's from a tax-free source. That's at the federal level. At the state level, though, each state has their own view on inheritance, similar to their view on the tax treaty. So most states don't have inheritance tax, but there are a few that do, such as New Jersey. And then capital gains tax is calculated quite differently in the US compared to Australia. In the US, when you sell an asset after holding it for less than a year, such as shares, you are taxed on the gain at your marginal tax rates. When you sell an asset after holding it for over a year, the IRS has long-term capital gains rates, which are typically lower than your marginal tax rates. Depending on your income levels, the long-term capital gains tax rates could either be 0, 15, or 20%, depending on how much your marginal tax rate is. So this incentivizes taxpayers to hold on to assets for over a year to take advantage of their lower tax rates, as opposed to selling things short term and maybe paying a higher tax rate based on how they land in the tax brackets. At the state level, some states do have preferential tax treatment for capital gains. One that I'm thinking of is Hawaii, but otherwise, most other states just tax the capital gains at your marginal tax rates.
Okay, well, I'm glad to report that brings it to an end, the core of the seminar. We hope that you enjoyed that, and I'm very grateful to Jason for joining me and putting in the effort to make this hopefully a good presentation for you all. We're obviously there and available if you need assistance with general advisory and questions, lodging your tax returns in the US, with Uptrend, and for Australia with ourselves, doing the planning both short and long term, and making sure that you end up in the best possible position regardless of where you end up on the planet and what your position is. A bit of good advice goes a hell of a long way. And you see in areas like US Australia, where it's even more complicated than usual, then certainly having someone strong in your corner like us is certainly going to be a big advantage. So thank you very much for your coming along and joining us today. We hope you found it informative, and we're going to take a few questions now, but we'll be certainly happy to help you out if you need assistance. And thanks very much for joining us.
Thank you so much, Steve and Jason. That was very insightful. Thank you to everybody that's emailed through questions and sent them through the Q&A area as well. We've been absolutely inundated. We'll try and answer as many questions as possible, but please be assured that we'll send you a recording of this webinar, and we will be in contact if you have sent us a question to be available to answer those. Just to reiterate on what Steve said as well, if you would like any US tax advice or assistance with preparation services, feel free to contact Jason at www.uptrendadvisory.com. And then if you'd like any Australian tax advice or preparation services, or to book a free initial consultation to discuss your personal circumstances, you can visit www.smats.net, or you can email paul@smats.net. Okay, so first question. If you depart Australia and become a foreign resident for tax purposes and then sell your primary residence in Australia, will you attract capital gains tax?
I'll probably tackle that one as an Australian one. And unfortunately, the answer is now, yes. It used to not be tax-free for up to 6 years, as I mentioned earlier. But now, unfortunately, if you sell whilst overseas, it's as if for tax purposes that you never, ever lived in it. And that becomes very, very expensive. Now, the other thing to be mindful of, and Jason can elaborate more, is that you also be careful about US taxes, because they can also look back, and hit you up. So, you've got to be really, really careful about, selling assets when you're overseas. And if you're in countries like US or Australia, you really, really should not go and do anything without checking advice, because, you could be hit with hundreds of thousands of dollars of tax that you thought would be zero. And that would have very much changed your decision, I'm sure, at the time as to what you would or wouldn't have done. So, you've got to be very careful of that new rule. If you've lived in that house, it's an issue. If you haven't lived in the house, it doesn't have any impact on you. The change doesn't have a bearing. But if you've lived in that house, it has a massive bearing.
Jason, do you want to add anything from that?
Yeah, definitely. So this goes back to what I was saying earlier in the session, where you need to be very careful where you're living in the US, because while you're afforded a tax credit at the federal level, the states are like their own countries. So if you're living in California or New York, where they don't respect or abide the tax treaty, they will fully tax you on that, and you'll have a nasty surprise. So again, definitely to Steve's point, seek professional advice, just that you have your eyes wide open before making such a big decision.
Thank you. Next question. I have an investment property with a mortgage in Australia. What are the tax implications of living and working in the US if we keep that property?
So this one, yep. So if you have that property and you're renting it out, besides having to declare it on your Australian returns, you will have to declare that on your US tax returns if you are a US tax resident. You will get to claim all of the usual expenses against that rental income, you know, mortgage interest, management fees, strata, utilities, everything. If that results in you having a profit, then that is when you'd want to claim the foreign tax credits for tax paid to Australia. And then hopefully you're in a state that allows the same credits. Otherwise, if they don't, they're going to take their little slice of that profit.
Question 3, can I continue making payments to my Australian super fund whilst living and working in the US? And will these be non-concessional contributions? And will the current limit of $27,500 apply?
Yeah, the answer is you can certainly continue to do so. You're allowed to contribute. The question is whether it's to your advantage to do so. So as I mentioned earlier, you know, I would be holding off putting any money into super unless I had a specific reason. You know, so you need to check, obviously, will it trigger tax in the US if you put it in there? Because you might end up needing more cash flow to make the same contribution. And you've got to say, well, what is the advantage? As I said, the closer you are to retirement age, the more likely you might put it in. The 27,500 is a concessional contribution. You know, that means you're getting a tax deduction on it. You know, then you can put in an additional $110,000 as a non-concessional contribution, which means that you're not getting a tax deduction on it. So you've got the opportunity to put money in there. But again, it needs to be given thought. You know, have you got another better use for that money, i.e. debt reduction, alternate asset acquisition? You know, do you need that money, or are you totally, no, that's spare to requirement, so I won't miss it if it's stuck in super? And what are the tax implications going to be? Does it help me in Australia but hurt me in the US? So they're the 3 key elements that you'd assess in making that decision. And again, you know, we always check first, you know, because it's not easy to answer those if you don't know what you're looking for.
Thank you. Is there a way to minimise taxes when retiring back to Australia with a 401k? And what % in taxes would I lose?
Yeah, so assuming you have reached retirement age of 59 and a half, that means there's no 10% early withdrawal penalty, which is the first hurdle for people repatriating. And then otherwise, it's about, you know, really planning out your various income streams, how much you have in super, how much you have in other assets, and then how much you have in 401k to kind of, you know, play around and see, okay, I've got this much from these other sources, and that means I have a shortfall of this to fund my life. And then that's how much you draw from your 401k. So it's, you know, the best answer is to withdraw as little as possible, because that way there's as little tax impact as possible, given, you know, the US doesn't have a tax-free threshold. You're taxed on the first dollar you make, and it's a marginal system. So it's really a personal one that you need to think through. And then separately, there's the knock-on impact of balancing what that means from an Australian tax perspective, because while there is the tax-free threshold in Australia, you might not just be drawing down from 401k, you might be drawing from other tax-deferred vehicles.
Thank you. If a US property has been held by an Australian resident for more than 12 months, when is the 50% discount available?
So if they're talking about from an Australian perspective, what happens is that to get the 50% discount, you need to have held that asset for more than 12 months. So that would normally mean date of purchase. But if you're a returning expatriate, the 12 months starts from the day of your return to Australia. So if you move back in July, you would theoretically not want to sell that property for 12 months in order to get 50% tax-free. Having said that, bear in mind that the past profits would be tax-free anyways. So you'd only be paying tax in that first 12 months on the profit from the day of arrival value to the eventual sale. So if you were going back in July and selling in August, September, it's likely that would be probably zero anyways. You'd probably be selling on and around the valuation. But if you certainly, you know, want to hold it long term, the 12 months is going to be from your date of arrival or date of purchase, whichever is the first.
Regarding inheritance tax, is the tax paid by the estate of the Australian resident? And would it be advisable for an inherited property to be sold if there's no other assets in Australia?
Yeah, the estate will only pay the tax if it actually sells the asset. So if the estate passes the asset onto you. So instead of giving you a check, it gives you a title deed. Then, if it gives you the asset, then the tax flows with you. Okay. So hence you would want the estate to adjust for any potential tax, and you'd certainly want them to give you the valuation, get that all arranged. But the estate will only pay the tax if they liquidate the asset and give you the proceeds. But if they hand you the asset, you will have the tax underlying, and you better find out how much that is, so that it's not a surprise later on.
Okay, and I'll wrap it up with one last question. And as I said, we'll get to all the questions in due course via email. The ATO tax form asks about foreign income. Does this need to be completed for a legitimate non-resident?
This is the ATO in Australia. It asks that because in Australia, just like the US, if you are a resident for tax purposes, you are taxed on your worldwide income. So if you're living in Australia, lodging an Australian tax return, similar to if you're living in the US as a tax resident there, you have to declare all of your income and capital gains from anywhere in the world. So it asks that question every year, and obviously you have to answer it truthfully. And what I always remind people now is these things, strange things called computers, they're doing so much cross-matching now that they will know whatever you've got anywhere in the world. So, the days of, oh, look, don't tell them, they've gone, right? So they can see everything. Everybody has to record their tax ID numbers in every country. They're swapping that information. So, make sure that you're compliant. And this is the great thing about, good quality advice is that, you don't have to pay a lot of tax to be compliant. You just have to make sure that you've got a reason that you're doing things, that it's thought out as to why, and that it's a calculated, sensible cost, and you're taking advantage of all the opportunities that are there for you to legally tax plan and reduce your tax to a sensible level in the bounds of the law. To do that, then declaring worldwide isn't necessarily a bad thing. It's a necessary thing, but it can be softened by the impact.
And Jason, do you have anything to add there from the IRS perspective about declaring your foreign income and your assets?
Yeah, so again, most of your US tax return as an expat is about compliance. It's, the tax treaty does exist to avoid double taxation and everything like that. But it's a little bit unfortunate that most of your experience with the IRS is really trying not to get fined. So there are definitely great tax codes, great tax benefits with real estate and owning your home, and long-term capital gains versus short-term capital gains. But when it comes to your foreign income and your foreign assets, you definitely want to make sure you're doing the right thing. So that way there's no surprises and nothing to be worried about.
Thank you so much, Steve and Jason, and thank you to everybody that's attended. We will send out a copy of this webinar within the coming days. But just to reiterate, if you do want to take advantage of a free initial discovery chat, visit uptrendadvisory.com or smats.net. And I'll wrap it up there. Thanks, guys. See you later.
Thank you, Steve. It was great to speak with you both.
Bye-bye, everyone.